Good afternoon. Welcome to our webinar. Today, I am Jonathan Hall, the CEO and President of Warburton Capital Management. So excited to have you joining us today and spending a little bit of your time today to talk about some important topics. It's been a volatile start to the year so far. We're rounding into May, almost at the halfway mark, and it's a good time to take a step back and review what's been going on in markets and, ask some questions of an expert. So we're really excited to have a special guest speaker joining us today. His name is Dr. Apollo Lupescu. He's a vice president at Dimensional Fund Advisors. Dimensional is one of the premier investment managers in the world, managing around $800 billion in assets. We have partnered with Dimensional for almost 20 years now in offering investment solutions to our clients. Apollo is a Apollo is a globally recognized speaker who's delivered hundreds of lectures and seminars to financial professionals and investors on various topics all around the country and all around the world. He's considered to be the secretary of explaining stuff. I love that. And there's a lot of stuff that needs explained, Apollo, so we're glad that you're here. Um, Apollo does a great job of explaining complex topics in a really clear and concise way. A little bit about his background. Apollo's been with Dimensional in Santa Monica for over 21 years. Prior to that, he taught at University of California, has a PhD in economics and finance from UC Santa Barbara. He also holds a BA in economics from Michigan State University, where he competed and coached water polo. Rumor has it, even to this day, he's still playing. And if he's getting not only in the pool, but he's learning to surf. I didn't know that, Apollo. That's exciting. So thank you for joining us. A couple quick housekeeping items just for the group here. Please feel free to ask questions. Okay, this is meant to be an interactive town hall format. Apollo came out to visit us in Tulsa a little while back and also last quarter. He's become a friend of our firm and is here to answer your questions as our clients and friends. So please do use that Q&A box. It's at about the 50-yard line on your screen. You should be able to pop into that and ask some questions. Please do that. Otherwise, and if you think of a question afterwards, feel free to email it to me or otherwise, and we can follow up. Otherwise, Apollo, I think we'll get this started with a question I'm hearing a lot right now. Okay. Um, I don't know if you've heard, but there have been some tariff talks recently that have been moving the market around. In all seriousness, there has been a lot of anxiety recently among investors who are finding maybe the pace of changes in the government unsettling, and there's kind of a sense of, well, is it different this time? This feels really different. Is it different this time? Should we not be invested in the market any longer because it is different? So, just from a high level, how do you think investors should think about these developments and how the market's responding? And is there anything that we should be doing in response?
Yeah. Well, first of all, Jonathan, thank you so much for the invitation to be back in front of your clients, and thanks to everyone for taking the time. And yes, I was in Tulsa not long ago, and I loved it. We're just talking about perhaps coming back because I had just a phenomenal city, and the people were just amazing. And that question that you posed, is it different this time? It is actually really not just in Tulsa, but across the country. And it's not one where I can say people are universally, anxious about the current administration or universally enthusiastic about it, but it's kind of like a mix. In every circumstance, I would acknowledge that about half the country is very enthusiastic because we had an election and we chose we chose somebody who would shake up the tree. That's what we wanted, and that's exactly what we got. So half the country is really pumped about this, and the other half who is a little bit anxious about, what does this mean? So I think that both of these are really valid points of view, and a lot of them they tie into our emotions tied to the election and what's going on in the country. And I think it's absolutely human to have these emotions. And what I'm here to tell you is that they're valid. I'm not here to make anybody feel good or bad about their views, but rather what I want to talk about is how do you acknowledge these emotions and at the same time think about your money, your investments in a much more pragmatic way by looking at the data and the evidence and understanding a little bit of dynamics of what's going on. So a lot of what I'm going to do is really try to educate and maybe bring some clarity to some of these big issues that are happening right now. So to that question, is it different this time? It's quite interesting because when we think about investing in the stock market, that has to do with ownership in companies. That's all it is. And I cannot just waltz in there and buy ownership in Warburton or any other a small company that might be in Tulsa or anywhere other the country. If it's a private company, that I cannot buy ownership in it unless the owners let me in. Some of these companies have moved and they got bigger and bigger and bigger to the point where at some point they became public. And what that means is they've opened up the ownership to the public at large. And what it means is that I did not start Microsoft, Coca-Cola, McDonald's, and yet I can go buy a piece of that company. I can own a piece of this. So the whole stock market idea is about ownership. And with the exercise that we're going through every single day, every second of the day is, well, how much is it worth to buy this ownership? And that's what the stock markets are trying to do, is set aside the emotions and look very pragmatically at this question. If you want to buy a share of a company, what is it worth today? And obviously the main consideration is what do I expect the company to make in profits and earnings down the road? Because if I own a piece of the business, I'm entitled to part of the earnings. So one of the fundamental pieces of how much a company is worth and the share price that you see on the news is what do I expect the company to make, the earnings that I expect to make. And that's what the market's evaluating every single second of the day. And as something new comes up, the market's kind of reassessing the worth of the company and it's moving it up and down. So in that respect, is it different this time? Are these things that we're going through right now, are they different? And I used to think, Jonathan, that perhaps we have seen something similar. And the more I thought about it, the more I realized that no, we haven't. This is different. This is unlike anything else that we've seen in the past. The same way that 5 years ago, when we're all stuck at home and they couldn't leave our house, that was different. So it is different this time. But the question that you ask, which is so important, just because it's different this time, does it mean that the old rules are gone? That what we considered investing is no longer applicable because it is different this time? And what kind of came to mind is something that talk about the pandemic happened a few years ago. I watched the series. I was telling you, Jonathan, before this, I'm watching Tulsa King. But before and back in the pandemic days, I was watching The Queen's Gambit, which is a show on Netflix, and it's about chess. And it prompted me to download the chess app, and I've been playing chess. And I'm not good, but I keep playing. And one thing that I realized is that every single game ends up in a different position, in different situation. No two games end up in the same position. It's always different. Then it kind of got me thinking, wait, the game of chess ends up different in a different position every time. And yet there is a fundamental premise that stays the same. You have a chessboard, there's 64 squares, you have 16 pieces on each side, and that premise does not change. So in the context of investing, is it possible that we are in a different situation today, and yet there is a fundamental premise, let's call that the chessboard of investing, that has not changed even as the situation is different? So that's what I've been trying to really figure out. Is there a chessboard of investing that stays constant even as the situation is different? And the more I thought it, I thought that chessboard of investing has three factors to it, three characteristics that are the same, in my opinion, even as the situation is different. Number one is that when you participate in the stock market, if there are free trades, if there's a voluntary trade, it turns out that investors are assessing every single second in a free market environment, what is a company worth it? And it turns out that when the president was elected, there was an expectation of deregulation and tax cuts and all that. And perhaps on that expectation, the stock market went up. when he got into the White House and the tariffs became obvious that that's going to happen, well, what do you expect to happen to the profits of the company that's going to have a harder time operating? Well, it went down, and that's what the market did. So, in fact, the market's going down. It is not a sign of weakness. It's a sign of strength for the markets because it's reflecting the fact that, boy, when business is good, markets go up. When business is going to be more challenging, companies are not worth as much. And that means that I should see a decline in prices. What else do you expect? And that's exactly what we saw. So I think the first thing that has not changed is that the markets operate freely. And when they move, like even though it's not pleasant for us to see, it's a sign of strength. It's showing you that there is an adjustment in price based on expectations. And I think that free functioning market is a huge chessboard has a huge piece of this because it tells us that hey, we can still assess the value in a free way. So I think that has not changed, and it's still happening today. There is a talk of perhaps having some meaningful conversation with the Chinese about tariffs. Well, what that means is perhaps it's going to be easier for companies to do business, and that the value of the market goes up. So I think that is really important, and that has not changed. The second part of this is that when you think of companies, these entities in which you buy ownership, these companies are really run by smart people, and these folks are going to try to figure out to navigate what is put in front of them. And what we found over and over is that these companies tend to be resilient. They tend to actually try to figure out how do I navigate what's put in front of me so I can still make money. And we see this just everywhere. Recently, somebody kind of pointed out to me that, look, I don't know if the good people at Google have a strong opinion about how we should name bodies of water, but hey, if you put in Google Maps right now, Gulf of Mexico, what shows up is Gulf of America, because that's kind of like that. That was there was a suggestion that came, and maybe I don't know if there's a law yet or something, but that's something that they thought is necessary for them to operate so they don't get in hot water. And by the way, that's what you see if you are in the US. But if you are in Mexico, because there's no law against that, it's still Gulf of Mexico. They're trying to figure out how do I navigate these times? And if you are all over the world, you kind of see it both ways. So to me, the point being here is that these companies will try to navigate what is put in front of them. And there's nothing new here. I mean, it's something that we've seen over and over and over again, companies doing and trying to navigate and figure out how do I take care of things given what's going on in the world. And we kind of saw it actually, come to think about it. We saw it also during the pandemic, because if you go to the pandemic, Ford, instead of making cars, they made ventilators, and that was something that they adjusted to. And you saw, aircrafts kind of being used for transport rather than passengers. Red Roof Inn, when they couldn't actually get travelers, they actually did this remote working for $29. You can get a room there. And then Zoom became a big part. So companies are very resilient. And I would say that even with the tariffs put in front of them, they're going to try to figure out a way to navigate this. And that has not changed, the resilience of companies and individuals. So that's the second thing. And the third element, so we had this idea of markets are still working really well. And part of the fact that they're working well is the volatility that we've seen. Number two is that companies are resilient. That has not changed. They're smart people, and they're going to try to figure out how do I navigate these times. And number three is that we still have incredibly strong institutions in the country. Jonathan, not too long ago, we had a free and fair election, and we chose a president. That's great. That was the will of the country. Let's just acknowledge it. Whatever side you're on, that was a free and fair election. And there are some policies that came with that election. And if these policies work, and I think all of us want them to work, we always want jobs and prosperity in the US. If these policies work, great. 18 months from now, there is another election, and we will reelect the politicians who champion these policies. Fantastic. If they don't work and the shelves become empty and you go see price increase and all this stuff, and these policies don't lead to a better future for all of us, well, again, it's a year and a half from now, all of us will have a chance to express our vote. And we know that voters are, voting with their wallets. And that's exactly what happened last one. A lot of the, people are disappointed with the inflation that was in the previous administration, and they voted something differently. Again, it's 18 months from now, a year and a half, not 5 years from now, a year and a half. The country has a chance to assess these economic policies, and if they work, fantastic. If they don't, there's no reason why we couldn't change course. So to me, these three premises, Jonathan, have not changed, and they form the chessboard of investing that is the premise that gives me confidence to stay invested.
Very good. Thank you for walking us through that, Apollo. I really like the chessboard imagery, and it brings to mind something I heard the founder of Dimensional say once, David Booth. Volatility is the spark in the engine of capitalism. It's the spark that
Absolutely.
makes things work. I look at this and say, hey, this is proof that the market's working. It's doing what it's
Exactly right.
supposed to be doing. But it's not fun. So let's drill down a little bit deeper on tariffs for a second. So
Yep.
obviously, President Trump did campaign on mixing up global trade, and very early on into his administration, made good on that promise through these tariff executive orders and implementation. So obviously that impacted the market. It has broader impacts for consumers and potentially on inflation and other items. What do you think some possible implications of this tariff policy are? And is there anything that we should be doing? That's probably the number one question I get
Yeah.
at Apollo
Yeah.
is
Yeah.
what should I be doing
Got
as
it.
a
Got it.
result of this?
So let's, I mean, it's interesting because I was at a client event in person not too long ago, and two folks came to me about and asked about tariffs, and one, was really like, this is the end of the world. I mean, this is just gonna crush everything. This is done. We're done. And the other one kind of suggested that, hey, what's wrong with imposing a fine on foreign producers who want to sell us things and steal our jobs. So what I felt it was necessary first, and maybe Jonathan, I'll start here, is demystify exactly what is a tariff, because it's a bit of a jargon. The same way that pancreas, I've heard the word recently. I know it's in my body somewhere, but I don't know exactly how it works and what it does. And I'm not a doctor, so maybe I should know, but I'm not an expert. It's jargon. Why not demystify a little bit what is a tariff and how does it work? Because once you kind of get a good sense of this, then you can start forming your own opinions on it. So let's illustrate this by using an example, a real example, and that is maple syrup. I had maple syrup this morning. I'm not Buddy the Elf. I don't put it on everything, but I do use it on yogurt. I do pancakes, everything. I buy it at Costco. So let's kind of illustrate the whole idea of tariffs using maple syrup at Costco. So in the good old days with no tariffs, I would go to Costco to buy maple syrup. Now, in order for Costco to sell me the maple syrup, they have to go get it from somewhere. So Costco goes to Vermont and says, listen, Vermont producers, I like to buy some maple syrup. And they say, I'll sell it to you. Great. They agree at a certain price. It's just there are not that many maple trees in Vermont and the US, and there are a lot more on the other side of the border in Canada. So Costco also goes to those Canadian producers and says, I'd like to buy your maple syrup. And those Canadian producers in their Canadian accent say, sure, I'll buy you, I'll sell you my maple syrup. And let's just say they agree at a price of $20 a bucket, just to kind of put up a number there. So Costco pays $20, gets the bucket of maple syrup to the US. And then they also have to add a few dollars for their warehouse, electricity, employees, their profit margin. So let's just say they add $5 to the 20 that they pay the producers, and I can go pick it up for $25. That's in the good old days with no tariffs. Now, the government says everything that comes from Canada is going to have a 25% tariff. And let's say that maple syrup is included in that. So what's going on now? The tariff is a tax. And what it means is that the company importing that maple syrup, in this case, Costco, has the legal obligation to write the government a check in the value of 25% of what they bring in. So if they bring in $20 of maple syrup, 25% of that is $5. So they have to send the government $5. And that obligation resides with the importing company, in this case, Costco. So what's Costco going to do? Where is this $5 going to come from? One thing Costco can do is go to the producer and say, listen, Mr. Producer Canadian, I have to pay $5 to the government now. So why don't you sell me the maple syrup for $15? And by the time I send the government $5, nothing changes. The Canadian producers look at each other like, wait a second here. It costs me more to produce. And by the way, where else are you going to get maple syrup? It's not like you can plant maple trees and get the syrup easily. So no, I'm going to keep selling you for $20. Take it or leave it. And Costco says, well, I have nowhere else to get it. I'll pay $20, but they still have to pay the government $5. Where is it going to come from? Well, they could take the $5 that they used to make in profit and ship it to the government and not change anything. But then you can't do that. You're going to get out of business. You're going to run out of business. You're going to go broke. So that's not an option. So the third option is that, well, I might need to increase the price. And the additional money that I get from consumers, that's what I'm going to send the government. So you have to think, folks, there are three parties involved in this. Number one is the producer. Number two is the importer. And number three is the consumer. So who pays the tariff? It is not obvious. During the first Trump administration, there was a 20% tariff on washing machines. So what economists did is look afterwards to see who paid that tariff. And this is what they found. 12 out of the 20%, so more than half, was passed on to consumers in the form of a higher price. And the rest were haircuts that the importer and the producers took. So the bulk of the tariff was passed on to consumers, and then the producers and the importers also took haircuts. Now, this split depends on each product because each product has a different dynamic. If there's a lone producer abroad and they're the only one selling in the US, they don't have a lot of leverage, so they might end up eating a lot of the tariff. But if a lot of the product is made abroad, and we don't produce much domestically, you don't have a lot of choices. You kind of have to pay whatever the producers want because you have nowhere else to get it. And right now, a lot of the things that we buy, they're made in China. It's not just like the cheap crap. It's everything. Like if you look at the Williams Sonoma plate, we just bought some, and you look on the back of it, made in China. So it's not just crap. It's actually quality stuff. All of this, unless you have a different place to get it, the producers might just kind of hang on and say, no, I mean, this is what it takes for me to sell it to you. So the split between consumers, the importer, and the producer, it is not obvious. It depends on product by product. But by and large, what a lot of economists have kind of looked at and said, listen, at least to some degree, in some cases more than others, the cost of the tariff of this tax will be passed on to consumers. Because even though the producer, the importer is legally required to collect it, it is actually not necessarily coming from them. They could generate it from either lower price from the producer or higher price from the consumer. So that's kind of how they work, and that's why you might have heard the idea of inflation. And that is a legitimate concern because, again, if these importing shops are starting to pass on the cost to consumers, and a lot of them have tried to do that because they cannot eat it themselves. They just don't have the margins. A lot of these retailers don't have the margins to kind of eat the 25%. They're going to pass on the cost, and we would see things going up. It's possible that because when the tariffs are so high, like 100+%, 150% or so with the Chinese goods, some importing companies are not even bringing merchandise into the country. So we're going to find ourselves perhaps in a situation like the pandemic where you can't really find strollers or whatever else you're looking for because it's too expensive. They're like, why would I want to buy this if nobody's going to, they're going to stay there because they're too expensive. So these are some of the dynamics that some folks have expressed, like we kind of need to sort this out because that's a legitimate concern. Prices going up, but also not having enough product on the shelf. And that being a concern. So the implication for consumers, us, is kind of it's possible that we might pay a little bit high or not see as much variety as we used to see as consumers. So that's the first one. The second thing that I want to touch on, Jonathan, is like, why do we even have these tariffs? Because it seems like it came out of nowhere and all that. Well, let me tell you, folks, why tariffs and how come they would just pop them? It's nothing really new. It's not like as a country we have not seen tariffs. And I would say that any country, not just the US, typically has three reasons why they would consider tariffs. And the first one goes back to 1776 and the formation of the country. Because back in those days, tariffs represented roughly about 80% of the federal budget. So revenue is one of the main reasons why we had tariffs in the early days of the country. Revenue, because you generated the bulk of what the government spent from tariffs. Now, around the time of the Civil War, we introduced the income tax. And over time, the income tax took over and became the primary source of government revenue to the point where last year, tariffs were only about 2% of the budget. So we went from 80% to 2%. So tariffs are not a meaningful part of the budget right now, but it's still revenue. So you can say, well, we're bringing some revenue, but it's a really small part of the government's budget. It used to be, but not anymore. So revenue is still being invoked today that we generate income from this. Again, it's partly us as citizens, we're paying these tariffs, but it's still revenue to the government. Number two is a restriction, and we want to protect certain industries, either because there are communities who would get devastated by the loss of jobs, or because there's a strategic importance to that industry to the country. From a security perspective, national security, and so forth. And that's been the reason mainly that we saw tariffs between the Civil War and about World War II. So restrictions and protectionism is the second reason after revenue. And the third one, Jonathan, it is reciprocity. That, you charge me a certain tariff, I'm going to charge you another tariff back. And what's interesting is that after World War II, the US actually had a different view on this. Instead of saying, well, I'll charge you 20%, you charge me 20%, they said, what if we lower our barriers? What if we don't actually charge each other tariffs and allow for free trade? And that has been pretty much the norm, except for some sectors or whatever. But for the most part, the trade has been free. And over the past 80 years, companies, from large companies to small companies, they have built production lines, supply chains based on this idea of free trade. And that's been the norm. And in my opinion, this is my personal opinion, the society at large benefited. Because if we wanted to decorate our Christmas trees and put some lights for the holidays, it wasn't that expensive. We had plenty of choices. You go to Home Depot, you go to Walmart, and you get them. It's great. And that was because of free trade. At the same time, certain communities got devastated, and there was an acknowledgement of that. They might have gotten devastated anyway because of technology replacing jobs, but there was a lot of hurt in some community that needs to be acknowledged, and those people became very vocal. And I think that everybody in society benefited, and we're all kind of like, yeah, it's just the way it should be. But certain people became very vocal, and those are the folks who got hurt by this globalization. And those voices became very strong in the political arena, and that's why I think a politician pays a lot more attention to those voices, even though the society is a large benefited. The trouble is today that and what the markets and companies are trying to figure out is that we have had 80 years in which they had built a certain business model. And now the idea that's coming from the administration is that we want to produce everything in the US. And I think that that's going to be challenging at the very least. And let me give an example of why that's the case. One of the big success stories that has to do with AI, and we're all familiar that AI is like an amazing thing, is NVIDIA. And NVIDIA is an American company that designs chips. And they design these chips, and they're just the most amazing. They're the best at designing these chips. And if you want an analogy, they're like a baker who came up with the recipe for the best cookies in the world. They just have the recipe for the best cookies in the world. The thing is, they don't have a kitchen. They can't actually manufacture these chips. So it turns out there's only one single company in the world that over decades, it has perfected a system to generate and produce these high-end NVIDIA chips. And that company happens to be in Taiwan, Taiwan Semiconductor Manufacturing Corporation, known as TSMC. And they're the only ones. They have the Taiwanese engineers that over decades, they kind of specialize and tinkered and so forth, and they figured it out. Nobody else in the world has done it. Intel hasn't done it. Chinese companies, no, only these folks have done it. And in order for NVIDIA to sell any chips, it needs to go to TSMC, and TSMC has to make these chips. And that's the oven. That's the kitchen. But in that kitchen, they need an incredibly specialized oven. And TSMC in this case needs a machine that is science fiction. Jonathan, if you were to shoot a laser beam from Tulsa to the moon, it could hit a ping pong ball. It's called lithography, and they're engraving transistors 10,000 times smaller than the human hair, not mine. And that machine is incredible. It took decades and decades. It's a global supply chain, and the company manufacturing that machine is in the Netherlands, and the company is called ASML. So, okay, in order for NVIDIA to have this global success that it has, it relies exclusively for the high-end chips on one company in Taiwan that is not going to move out of Taiwan. You can't just pack your bags and move out of there. And then that TSMC relies on a Dutch company that is certainly not going to move because of the factories and everything they produce are there. So to kind of say that now we're going to somehow replicate all of this in the US in a flash like that, it just becomes really hard to fathom how that can be done. And I think that's kind of what some of the market reactions have been like. We don't see how that's feasible. I personally don't see how that's feasible. But that's been sort of the part of the issue is the restructuring and of 80 years of free trade in a matter of days or weeks when really after 80 years, it's such a global supply chain that it's just incredibly hard for companies to do it. And that TSMC example just kind of illustrates to you like we can't really produce everything. And there are other items, obviously, like mangoes. We can even produce mangoes in the US. And I think the Secretary of Commerce basically said, yeah, don't expect us to make any mangoes. We can't. The president says, well, Royce, where else are you going to make Rolls-Royce but in Britain? So there are certain things that are really like right now is like, okay, we're going to impose a tariff, but we can't get it from anywhere else. So it's a challenge for companies to figure out what to do. Now, the last part of this, we kind of figure out what is a tariff, why do we even have them, and the third part is what does it mean to you as an investor? And what I'm going to suggest to you is there are two important elements for any investors to consider. First one is that markets tend to really pay attention not only to the stated policy, but what is expected. And the markets, they tend to price in expectations even before the policy is enacted. So it is really important that the markets are good at looking ahead and trying to incorporate expectations in the prices. And secondly, what we found over and over, and I'll illustrate with some data, is that tariffs are certainly a factor in the stock market, but it's not a primary factor. It is not the factor that drives the success of any one company or the market as a whole. So, Jonathan, let's just quickly wrap this up with an example. During the first Trump administration, the idea was let's make more things at home. And one of the industries that they picked on was steel. So if you look at a company that carries the name of the industry, United States Steel Corporation, what you see is that in the early days of the Trump administration, what you saw is that the stock price went from about $40 a share to less than 20, lost more than half of its value. And then the administration started to talk about perhaps imposing tariffs on foreign producers to protect domestic companies. And perhaps on those expectations, what you saw is a huge run up in the price of the United States Steel Corporation. And again, there was no clarity that the tariffs were ever going to be imposed, but there was an expectation. And on the expectation, the stock price has already moved up. And the tariffs were indeed introduced in March of 2018. And at that point, that gave U.S. Steel a huge competitive advantage in the domestic market. And as an investor, I might say, well, that's it. This is it. I need to go and jump all over U.S. Steel because it's now got the backing of the U.S. government. It has the U.S. government behind it. So what would have happened if you actually invested in U.S. Steel when the tariffs were announced? Well, between that point and when the election was lost in November of 2020, the U.S. Steel lost the vast majority of its value. The vast majority of its value. It didn't do anything for U.S. Steel. And if indeed tariffs were the primary driver of a company performance, you would have seen U.S. Steel go up, but it wasn't. And by the time the tariffs were introduced, that market has already priced it in. Now, what about the market as a whole? And again, if you go back to 2017, the same way that we have right now, like every day, like every week, there's like an announcement that tariffs are up, they're down, it's trade wars and all that. We had exactly the same experience back in the first Trump administration. And if you look at the U.S. market, represented by the S&P 500, so now a single company, but the largest 500 stocks in the U.S. market, over those 4 years, it would actually work out really well. $1 invested in the S&P 500 at the beginning of the administration, by the end, it would have gone up by roughly about 80%. So $1 went up to 180 in 4 years, despite all the trade wars and the tariffs and everything that seemed like is going to derail the market. It's going to be a disaster. It turned out really well for investors. 3 out of the 4 years are positive, and the market as a whole went up by about 80%. Now, the thing is that we were trying to inflict punishment on the Chinese. So the question is, if you are now saying, okay, let's just keep the money in the US, but should we actually pay attention and avoid the countries that we are targeting? We can look at China. And China, over the same exact 4 years, did not go up by 80%. In fact, the Chinese market went up by 100%. It outperformed the US market despite being the target of our tariffs. So again, if tariffs are the primary driver, why would the Chinese market double in 4 years and outperform the US market? And here's where it gets interesting. If you look at April 30th, so this is like April 30th of this year, and you look at the US stock market, the S&P 500 was down roughly about 6%, give or take in that neighborhood. And where it gets interesting, Canada, our neighbors to the north, the one that gave us the maple syrup, and we're kind of picking on them, they are up 5.5%, so significantly outperforming the U.S. Germany, again, we have a target on Germany as well, and they're up by about 24% for the year. China, as we mentioned, they're the big recipient of these big tariffs. They're up 10% in their stock market. And even Mexico, our neighbors to the south, they're up about 23%. So if indeed tariffs were the primary driver of a stock market, why would the US be down so much? And all these other countries that are really much more dependent on trade with the US than we are trade with them, why would they be up so much? And the only answer, in my opinion, is that tariffs are one of the factors, but not the primary one. There are other considerations that play in the stock market. And because of that, to answer your question, Jonathan, we do not recommend that people deviate from their financial plan, but rather actually stay invested and stay disciplined, because the markets do react very quickly to this information. They've already priced in an expectation of changes in policy, and ultimately, it is not the main driver. There are other factors, because it's otherwise it'd be hard to explain why the Mexican market is up 23% through April, where we're down 6%.
Well, and that's, I think, a really important point. Uh, in the last couple of months, we've had some of the best examples of the market incorporating information quickly that I've ever seen. I mean, you had one day where there was a fake news tweet that went out and said, "Hey, there's going to be a pause on tariffs." And you remember that? And the
Yep.
market spiked 10% in a matter
Yep.
of moments. And then it
Yep.
came out, "Hey, that's not true." And the market went right back down where it was. And it just goes to show that markets are incorporating information, no matter what we believe about the impact of tariffs or what it will do to trade or what it will do to the global economy. Markets are forward looking, and they're incorporating all that data every single day.
Absolutely. And to that point, that's a great point, because it's a one-time adjustment. This is not going to be, I'm going to adjust this and then I'm going to still take another 2 weeks to adjust. No, this is like, once the adjustment was made, it's some other piece of news that's going to move the market, but it's not going to be the same piece of news. So that's the thing, that any news about the tariffs is going to impact at the moment. And from that point on, there'll be something else, good news or bad
Mhm.
news.
Right. And I always try to remind clients too, the markets, what we see happening in the stock market and what's happening in the economy are related. The economy is an input, but they're not always perfectly correlated and timed perfectly. You might see the market go down and then start to go up after the recession is declared.
Yep.
If there ever is a recession, off of this or a recession in the future. You might see the market go down in advance, and then the recession's declared, but the market's already started going back up.
Right. Are folks concerned a little bit about the recession?
I've gotten some questions about that. Is there a
Yeah.
pending recession, and what might that mean?
Yeah, and I think one important consideration is that, folks, the recession is not the media declaring it. It's not like, oh, there are two negative quarters of economic growth, whatever that means. What does it mean, economic growth? Well, it basically means that we're trying to package every single thing that's being made, every latte, every car, every new house, every massage, everything that's being made in the economy, all the goods and services packaged into a single number. And the number is called the gross domestic product. And if that number goes up from quarter to quarter, the economy is expanding. If it goes down, well, that's not good. If you have two of these declines in a row, it's called a recession. That's, first of all, like that number. Can you imagine how hard it is to compute and how imprecise it is, and quite often gets restated? But number two is that's not what the recession means. It turns out that back in 1978, Congress, instead of delegating to the media the responsibility of declaring a recession, they basically said, no, since 1978, we need to have a group of economists telling us if we are in a recession or not. And that group is part of the National Bureau of Economic Research. And it currently has 8 members in this business cycle committee. And these are the current members. They're all academics from Stanford, Northwestern, MIT, Cal Berkeley, Harvard, and Princeton. And we have delegated to them the responsibility to tell us if we're in a recession. And these committee members, they use data like GDP, unemployment, industrial production. They look at a lot of data, and sometimes they're very subjective and they use their own judgment. The last recession we had was in 2020, and that was only 2 months. So theoretically, that could not have been a recession because we didn't have two negative quarters. But they thought that the economic slowdown was so significant that let's declare a recession. They are the only ones who can declare the recession. And if you go back to 1978, Jonathan, they have been 6 declared recessions. And the shortest one was during the pandemic, even though there was one of the worst in terms of unemployment, over 14% unemployment in April of 2020. And the longest ones have been in the early 80s and in the financial crisis. The average, so the average recession lasted about 10 months. So it's not really a lifetime, it's 10 months, and it is as short as 2 months. And the question I mean, this is really important. What you said is that because the markets are forward looking, the economy and the market might not move in lockstep. And what it means is that markets being forward looking means that if it's a if let's say it's a sunny day, it's beautiful out there in Tulsa, it's great, but then you look on the horizon, you see clouds, and then you pull up your app, oh, it's going to rain. Well, you're going to grab an umbrella before the rain comes in expectation of the rain. That's what the market does. And the opposite is also true. If it's a cloudy, stormy day, but you see the sun is coming out, you're going to grab the sunblock with you. And that's what it means to be forward looking. And in that respect, these two, the markets and the economy, don't have to move in lockstep, because we might be in a really good economic situation, but if the markets are anticipating a downturn, they're going to price it in before it even happens. Now, we talked about 1980 as being a terrible economic year. And in that year, we had very high unemployment. Unemployment was, I think, almost 8%, so twice as much as we have it today. The economic output was horrible. It dropped by 10%. We had low housing starts, retail sales. Inflation was so high. It was about 8% inflation. So everything was terrible. And if you're an investor, you can easily look out there, look at the window and say, this is not good. Why would I want to be invested in a time like this? And in 1980, this horrible economic year, it turns out that the S&P 500 was up 32%, more than 3 times the average. And this is not because the markets are disconnected from reality. Markets were seeing their better days ahead. 2009 was the other really tough economic environment, and the other tough recession. And it was, in some ways, '09 was as bad as it was since the Great Depression. And again, you can look out there and see skeleton buildings, nobody working on them, unemployment was huge, and say this is not a good time to be invested. Well, in 2009, this horrible economic year, the S&P was up 26% because perhaps the markets were seeing the light at the end of the tunnel. And the last recession, the short one, the 2 months, even in that year, the S&P was up. So again, the same way that we did not suggest that tariffs ought to be a reason why you want to trade or make a move with your money, it's the same with the recession. Whether it's a good economic time or a bad economic time, we don't suggest that people deviate from their financial plan because it doesn't appear to be like a clear signal for buying or selling.
Sure. I wish it was that easy, but it's just not. Um,
And the data kind of shows you that like, yeah, if you see it's really bad economically, maybe that's a good time to consider rebalancing and buying rather than selling.
Sure, sure. Okay, I'm going to pause for a quick second and remind everyone there is a Q&A box right about halfway along your screen on the 50-yard line. Feel free to go in there and ask some questions. We still have time to get to a couple of your questions. Maybe something we've talked about has made something come to mind. So please feel free to do that, and I'll try to make sure that they get asked. Apollo, one thing that we've seen a lot of in the news, and clients have been asking about it too, is discussions around the reserve currency. What if the dollar loses its reserve status? And then tangentially to that, you log into the Wall Street Journal this morning. What's the first thing we saw? Market's up 3% today. That's great. Gold's down 3% today. I know some people try to view gold as maybe this hedge against the dollar losing its reserve status. So maybe you could kind of package up those two thoughts into some analysis.
Yeah. So that's an interesting issue and a very big issue. And I would start with just the concept of reserve currency. And I've seen a lot of this being mentioned in the in newsletters. They're being pushed out there to investors. And I have to say that quite often the way that it's being described is there's a huge loss to the U.S. and potentially the dollar can lose its value and it's not going to be worth as much. The idea of reserve currency, I think it's a very complicated issue, and there's nothing really that it's so clean to say what exactly is a reserve currency. Is it the fact that the U.S. dollar is being used in international trade? What does it mean that the central banks hold dollars and maybe they're holding fewer dollars? It's really not clean, the same way that recession is not clean. I cannot define clearly to you what exactly is reserve currency and why is it that it's important to any of us, whether it's in Oklahoma, whether it's in Los Angeles or Florida or you name it. To begin with, let's understand the dollar. And once we understand the dollar, you can get a better sense of what reserve currency might mean. It used to be the case, and this goes back about 100 years ago, more than 100 years ago, where we made a decision as a country that we can really trust the government to print dollar bills without kind of having something tied into it, a precious metal. And in fact, there was an election in the early 1900s, and there were two competing candidates. One was McKinley, and he was advocating for gold, and there was another candidate advocating for silver. I can't remember the name of the candidate because he lost. And McKinley won, and gold
It
became
was
the
it was
gold
William
standard.
Jennings Bryan, by the way.
Thank you so much for I
You're
forgot that.
welcome.
By the way,
I was a
quick little
history
fact.
major.
Quick little fact, Jonathan. I was in Alaska not too long ago, and somebody kind of asked me, why is this? Somebody in my group asked the guide, why is this mountain at Denali National Park called Mount McKinley? And it turns out that it was a cartographer who was also a gold digger. And back in those days, the gold digger kind of like when he was mapping this mountain, he wanted to promote candidate McKinley, and he said, I kind of like the idea of the gold being the precious metal tied to the dollar. So he called that Mount McKinley, despite the fact that McKinley had never set foot in Alaska. But nobody called him McKinley there, but he thought that if he puts it like that, it puts it on the map, that's going to help the visibility of the candidate. And maybe that helped because he did win. But the reality is that Mount McKinley is called because of this prospector who wanted gold to be the gold standard. Anyway, long story. what happened was over the past, since after that election, gold became tied into the dollar, and in order for the U.S. government to print a dollar bill, it needed to have gold in the bank. And that gave people confidence that, hey, there's value there because it's always backed up by gold. But in the late 60s, early 70s, economists were pointing out that we have more people in the country, the economy is booming, and we're just not digging up enough gold to print all the dollar bills that the economy needs to function. So what happened was in August of 1971, President Nixon goes on TV and tells the world that as of today, the dollar is no longer tied into gold. It just that relationship is gone. And from this day on, because we're no longer tied into gold, the US government can print dollar bills at will with no backstop. Can run the printing machines 24/7, and there's nothing that prevents it from we're doing it. And that was a bit of a shock to the system. And because of that, he actually put in place a 90-day wage and price freeze that he couldn't increase price or wages because people are really anxious. Wait, we're really going to trust the government that they're going to print this in a responsible way, the dollar bills? But that was the case. That's what we did. Since 1971, folks, the value of the dollar doesn't come from the connection to gold. It's that we trust that the dollar has value because we all have this collective, I won't say delusion, but we all have this collective belief that the dollar has value. And that's what gives the dollar value. Nothing more than that. So to begin with, it's not tied into gold. So the idea of gold and gold being somehow a good hedge, that's a legacy idea. That stopped in 1971 for most people. Now, here's the thing. In the 70s, we did have pretty high inflation. And one of the things that became interesting is that the responsibility of printing dollars did not rest with the US government, but rather the Fed. So it's not the government printing money. That's a myth. It's the Federal Reserve that releases dollars in society. And in the 1970s, a lot of the Fed policymakers, they're caving in to the political will of the leaders. And they're basically making monetary policy. The Fed was making decisions based on what the politicians wanted. And in 1978, a different chairman came along. His name was Paul Volcker. And he said, no more of this. I'm going to fight for the independence of the Fed. And we're not going to make decisions to please politicians, but rather because they are the best decisions that we can come up with as economists in this uncertain world. And since 1978 or so, the Fed has fought fiercely for this independence. And once we got past those early days of the 80s, I got to tell you folks that if I reflect back on the past 50 plus years, the Fed has done a tremendous job making and keeping the dollar valuable. They're not perfect in their decisions, but relative to all the other currencies in the world, this is the most sought after currency. Anybody who wants to trade, I don't care what the politician said. If you have a Colombian coffee maker dealing with an Italian vendor on the street, well, both of them would say, yeah, I'm super happy with the dollars. So the dollar is de facto the only currency today that people prefer to have. Even the Russians, the Chinese, all of them, if you ask them, what would you rather have? They all say the dollar. The dollar is still believed to be the currency that most people prefer. And part of it is that there is no alternative. If you're going to say, well, I'm not going to trade in dollars, what else gives you confidence? The euro? The Chinese renminbi? The ruble in Russia? Exactly what is the competing currency that would come across? So there has nothing that has come about. And to me, a lot of this has to do with the Fed independence. And one of the things that I have to say to everybody who would listen is that whenever you hear a politician trying to interfere with the Fed, you might not agree with the Fed decisions. Absolutely. They might not make the perfect decisions, but I can tell you folks, they're giving it the best shot based on the information they have at the moment. Could they be too late or too early? Maybe, but they are not making political decisions. And they've done an incredible job keeping the dollar as a solid currency. So all this is coming to say that Fed is not perfect. But as long as it's maintaining independence, I think it gives people confidence that the dollar will have value. And the only time when we should be concerned is that if politicians are starting to kind of impose their view on the Fed, which their view might be about election short term rather than just really solid economic thinking, that could be an issue. But as of now, I can tell you, there's nothing else in the world that would even get close to dollar, not even close to dollar. The second thing that I can tell you is that gold is not what you think it is. It is not a store of value because it's not tied to the dollar anymore. And the value of the gold is pretty much tied to basically non-economic reasons because you know, unless you have industrial production, gold doesn't do much. You can't really exchange it for dollar the way you used to do it. So we don't recommend like just really going out there and panic and buying gold because you already have exposure to gold in the form of companies that make money out of gold. And that an example like that is Newmont Mining. It's one of the best performing stocks this year. Up to the end of April, is up roughly about 40% in value. So you did have gold exposure through the stocks, and I think that's a really good way to do it. Put it, you know, in the context of the broad economic environment, and you look at relative to AI, relative to transportation, relative to gas and oil. You know, you're going to have gold, but you're not going to overdo it. So I think that's the smart way to think about it, in my opinion.
Thanks, Apollo. We've got a couple of questions that came in, so we'll do a
Yep.
rapid fire Q&A session here right at the end,
Yep.
Apollo. So the first one, very thoughtful question. So if there is a negative trade balance, if the U.S. maintains a negative trade balance, is it ultimately transferring wealth out in the process and eventually will go bankrupt if that continues for a long time?
Yeah, I don't believe that. I mean, I think that trade balance is not necessarily a great indicator because I'll give you an example. I run a trade deficit, significant trade deficit with my supermarket. I keep giving them money and they don't buy anything from me. But it doesn't mean it's disadvantageous to me. I mean, I am finding value into them selling me something so I don't believe that the trade per se is any kind of trade. If it's voluntary, it's favoring one party or the other. I just think that in some ways we are focusing as a country on certain things. We're much more of a service industry, and we have chosen that we're going to be like 80% of the economy in the U.S. is service industry, and we choose not to have the pollution that comes with making plastics and so forth. So we kind of choose, let's give it to somebody else to do it. So we have surpluses in certain areas. We have deficits in others, but it doesn't mean that any country is taking advantage of us. I don't believe that at all. I think that if it gets too big in some ways, we have to reevaluate. How can we help our industries be more competitive? But I think that to me, trade and free trade allows us to have the most choices at the lowest price and with the best features. And I think that if you start restricting and say, well, you know, they're selling us too much stuff, why is that? And I think that if you artificially try to protect an industry in the U.S., you're going to end up with again higher prices for consumers, fewer choices, and not as high quality. So I don't believe that the trade deficit it has any meaning because we all of you folks run trade deficits with your local coffee shop. How much are they buying from you? Nothing. But you're buying from them, and I'm not sure that you feel like they're taking advantage of you. It's just trade is a very complicated thing, and just because there's a trade deficit, I don't believe that that's necessarily a horrible thing. And if it becomes too big, you have to wonder why. What is it that we don't do well enough, rather than just like why are they doing this to us?
Thanks, Apollo. So one more question. This is a great one to wrap up on. I I think it's a great question, actually. So if the conclusion is, okay, volatility that we see in tariff news are not meaningful inputs for making trading decisions. We shouldn't trade based on them. Are there any events or economic developments we should be watching out for that could happen that would be worth considering for trading?
Yeah, absolutely. And they absolutely are. And they're less around the economic events or any one particular thing that would cause you to trade, but rather there's something else that I would consider trading. And that is that most successful investors, in fact, every successful investor I know has a financial plan. And well, financial plan takes account of your circumstances, your needs, when do you need the money, how much money you need, what are assets you have, what's your risk capacity. And that financial plan typically translates into an asset allocation. What asset allocation means that you're splitting your money between different types of investments. And the two big ones are one are called stocks, which is ownership in companies. The second one is bonds, which is a form of lending. You provide funds to governments and corporations in the form of a loan. So once you have a financial plan, there are times when, for example, the stock market drops significantly or whatever degree. And at that point, that the balance that it's supposed to be between stocks and bonds is no longer the one that was determined by the financial plan. So if you have one investment that has gone up and the other one that has gone down, the portfolio is not in alignment anymore. And at that point, you can consider, and this is what advisors do. This is one of what Jonathan and the team do. They consider, is this the right time to perhaps trim some of the gains, take some chips off the table and buy something that has gone down in value, such that when the stock market recovers, you're not going to be too light on stocks. The opposite is also true. If the stock market's running up and up and up and up, we've had years of the US market running up and up and up and up. Instead of just sitting there doing nothing, there are times when, again, you might want to trim those to get the portfolio back in alignment. And that process is called rebalancing. And it's a systematic one that is not driven by economic events or anything. I don't believe there are any of those clear indicators because everybody in the world would trade on them. So I don't believe that'll be the trigger, but the trigger should be how are these percentages between different investment categories relative to what is determined by the financial plan. And at times, that's what the team there decides is like, is this the right time for us to do a rebalance? And the opposite could also be true, which is not rebalance, but if something has gone down in value, you can also consider times when it might be worth selling to realize the loss and then buy something similar, not substantially identical. And this way you have a tax loss that can offset gains down the road. So these are the two main things that I would say you can do, not triggered by economic events, but the percentages in the portfolio, either as rebalancing or as loss harvesting, the way it's called, tax loss harvesting.
Yeah, thanks, Apollo. That's a great reminder that ultimately we are investing to accomplish goals, right? And to execute on the financial plan that we've set forward on with our clients. And so that's what we're doing during volatile times is trying to find every silver lining that we can out of turbulent markets. And oftentimes either rebalancing or tax loss harvesting are key parts of that. Apollo, I want to thank you so much for your time today. Thanks for joining us. To our attendees, appreciate all of you taking some time out of your busy day to join us. It was a pleasure having you. And if this conversation caused any questions or any desire for follow-up, you're always welcome to reach out to me, and we can get your questions answered. We'll also try to make a recording of this available afterwards. So if you missed part of it or want to rewatch it. Thanks again. Hope you all have a great day.
Bye bye.